Now, after the closing bell, it was the tale of two tech stocks, earnings from tech bellwethers Amazon and Microsoft, and the results couldn't have been more different. We begin with Amazon.com and the e-commerce giant's huge miss, reporting a loss of 95 cents per share, much bigger than the 74 cents that analysts had forecasted. Revenues also came in below expectations, but only by a fraction, and the number increased from last year. Amazon's sales guidance for the crucial holiday quarter also came in below Wall Street estimates. Shares plunged nearly 11% in after-hours trading. They were flat in the regular session today. Bertha Coombe joins us now from the NASDAQ exchange with the one big takeaway from Amazon's disappointing report. Bertha?
You know, Susie, I think increasingly people on the street are saying we love using Amazon. A lot of folks love using it. There are a lot of consumers who really like the service. But it seems as though Amazon can deliver on everything except earnings and profits. And for a long time, because they were growing so fast, a lot of investors forgave them that. But that time is now drawing to a close. And people are starting to say, maybe you're just in too many things. You're in content, you're in devices that you now give away for free. You're also increasing your delivery options. But when are you going to pay us with better profits?
All right, Bertha, stay right there if you don't mind as we look now at Microsoft's very, very different story. The software giant topped forecast. It took in 54 cents a share. That was a full nickel above analyst estimates. Revenues, $23 billion, were $1 billion more than forecast and much higher than they were a year ago, as you see right there. But net income did fall 13% from last year. This after the firm took a more than $1 billion charge related to mass layoffs in its Nokia handset division. At the same time, Nokia handset sales were actually strong. Shares of Microsoft initially moving higher, sharply so, as you see there in the after hours. Bertha, once again at the NASDAQ, the big takeaway for you from these numbers from Mr. Softy.
Microsoft is cool again. Satya Nadella took over in February from Steve Ballmer, and he has really set a tone of modernizing Microsoft, moving away from software sales, from those little packets and disks to on the cloud. That's where things are moving, and also moving more towards mobile. The cloud computing revenues doubled, still not a huge part, but it just shows that he's starting to change this big and turn this big ship around. And for now, the honeymoon continues for him.
All right, Bertha, thank you so much for reporting on both those companies. Now, let's bring in David Garrity to talk more about Microsoft and Amazon. He's principal at GVA Research. David, let me just start out by saying that I know going into these earnings reports, you were not recommending Microsoft or Amazon. Now that you see the after-hours reaction with Amazon's stock down sharply 11%, Microsoft's up sharply, have you changed your opinion?
Well, in terms of Amazon, we still would be probably even avoiding the stock maybe as a holiday year-end shopping trade, just given the disappointment we were seeing in terms of revenue guidance for the December quarter. I mean, there are some concerns here quite clearly with respect to Amazon. We don't really see a lot in terms of profits falling to the bottom line. We have seen good sales growth, but that sales growth is decelerating. And anytime you're seeing a stock that's trading very, very high multiples in terms of earnings, slowing growth is death. As far as the stock is concerned, we're not surprised to see it down so much after hours.
What about Microsoft? Microsoft's numbers were pretty good. They've got a new CEO, albeit one with a somewhat controversial pay package. What do you think of Microsoft, and do you like it anymore today? You have a hold on it.
Well, in terms of Microsoft, seeing this very nice acceleration in terms of the revenue growth. I mean, the revenue growth at Microsoft up 25% year over year, obviously up better than the 20% we saw from Amazon. But certainly that revenue growth is being driven by some fairly high profit margin areas. Their cloud computing initiative, where they're taking share away from the likes of IBM and also potentially away also from Amazon. I mean, certainly we think with regards to Microsoft, there are some challenges. They have some legacy businesses, which are very profitable, but where there's slow growth. And we do have to see how is the company going to re-engineer its breadth in order to get the stock over $50. But we do like Microsoft here. We'd continue to hold. Obviously, Amazon, we were thinking there might have been a trade going into year end. Looking at these numbers, we would reserve judgment.
Bertha brought up two interesting points on both of these companies. With Microsoft, she's saying it's cool again. It's a cool stock. I wanted to get your thoughts on that. And then about Amazon, saying that some investors saying it's in just too many things, and when are they going to deliver a profit? Your thoughts on both of these?
Well, in terms of Microsoft, I mean, we do have some very nice upgrades taking place in terms of their Xbox game console, but that's something that's probably a once-in-a-decade phenomenon, so we can say if it's cool, it's only temporarily so. In terms of the cloud computing initiative, certainly we need to see continued progress there. I would say, if people wanted to look at a company that was cool, obviously you have to look at Apple, and then when you size up Microsoft against Apple, Microsoft looks maybe a little more attractive, but not necessarily cool.
So I was going to ask you if these two big mega cap tech stocks aren't particularly your taste right now, what is? You mentioned one, Apple. Are there any others in sort of mega cap tech land that you like?
Well, we think, Apple clearly, Google, despite the fact that they had somewhat disappointing results, we think is set up well for the end of the year. We think Google over the next 12 months could be potentially a $700 stock. We also like Facebook, which we think, showing very solid growth metrics and a valuation that's attractive, selling less than 1.5 times its growth rate. So we think that Facebook selling at about in the low 70s probably could be somewhere up near 100 within the next 6 to 12 months.
All right, lots of good information. Thanks a lot, David. David
Thank
Garrity
you.
with GVA Research.